Welcome to the Deep Dive. This is where we cut through all the noise, take that stack of source material you send us, and really try to turn that information overload into, well, strategic insight.
Yeah, and if you've been keeping an eye on the decentralized finance space, DeFi, over the last couple of years, you might have felt things got a bit cold.
A bit. I mean,
Yeah.
the narrative during the bear market was pretty grim, wasn't it?
Grim might be putting it mildly. Honestly, the popular take was that the DeFi we thought we knew was basically broken. A house of cards built mostly on these inflationary incentives.
Right. Unsustainable hype.
Exactly. But the sources we've pulled together for you today, they tell a very different story, much more dramatic one, actually. The big claim is that DeFi is officially, and I'm quoting here, back from the dead.
Okay. Back from the dead. That's a bold statement. And it's not just based on, like, wishful thinking or some random pump. No, not at all. It's backed by this single, really quite staggering data point. A $600 million rebound. That's in total DeFi protocol fees generated just in the last quarter alone. Wow. $600 million.
Yeah, that $600 million number, it's basically the center of gravity for this whole analysis we're doing. And just to give you some perspective, that's one of the strongest revenue quarters the whole DeFi ecosystem has seen since the crazy peaks back in 2021.
So not just a blip then.
Definitely not. It's real evidence of, sustained fundamental business activity coming back on chain, real usage.
Okay, so that's our mission today, right? We're going to do a deep analysis of the why. Why this fundamental surge? Because according to the sources, this isn't just hype making a comeback.
Exactly. It's driven by a really critical pivot away from those unsustainable growth models, the crazy APYs, towards something much more tangible, more mature business metrics.
Things like actual, verifiable revenue.
Yep. Verifiable revenue, strategic token buybacks, we'll get into that, and a real focus on utility, like value accrual for the token holder based on the protocol actually doing something useful.
Gotcha. And before we really dive into the mechanics of it all, maybe we should just briefly touch on the context of the source material itself.
Good point. Yeah, the kind of high signal content we're analyzing here, this sort of deep exploration, it really does depend heavily on community engagement.
You mean like people actually watching, commenting?
Exactly. Subscribing, dropping a comment, hitting the like button, all that stuff genuinely helps boost the visibility of quality research. In the algorithm. It lets analysts and creators keep making deep dives like this one.
It's kind of a crucial feedback loop, isn't it? Quality content needs that community support to, well, cut through all of the noise out there.
Totally. It ensures these kinds of insights keep getting made.
Right. A meta-narrative about fundamentals supporting fundamental analysis. Okay, so let's ground ourselves again. That huge $600 million figure. When we talk about protocol fees, what exactly does that mean, and why is that number such a big deal now compared to, say, last year?
Okay, yeah, good question. So in its simplest terms, a protocol fee is basically the income stream for the decentralized application itself, the software.
Like the fee you pay for using the service.
Precisely. If you use Uniswap, biggest decentralized exchange, DEX, to swap tokens, a tiny percentage of that trade, usually somewhere between 0.05% and 0.30%, that's collected as a swap fee. That's revenue for Uniswap.
Okay.
Or if you're using a lending platform, maybe like Aave, the interest you pay on a loan, or maybe a fee they collect if there's a liquidation event, that's also revenue for Aave.
So the $600 million is the total pot from all these top protocols just doing our main job.
That's it. It's the gross operating income they generated simply by performing their core function. Trading, lending, borrowing, whatever it is.
And that number isn't just big in isolation. You mentioned It signifies acceleration.
Exactly right. It's nearly double the fee generation they saw in the same period just 1 year before.
Double?
Yeah. And that acceleration, it suggests, is that the mechanisms these protocols use to make money, which are tied directly to people actually using them, to demand they found real product market fit on a scale we haven't really seen since the peak of the last bull market.
So it validates the utility, not just the token price going up.
Perfectly put. It validates the underlying usefulness. Okay, that sets the stage perfectly then for our first section, the $600 million pivot. This story of DeFi maybe finally maturing into a real economy. We need to really break down the contrast between that last cycle and what the sources are calling this DeFi value era.
Yeah, let's definitely contrast those two periods. So 2020 to 2021, often called DeFi summer, right? It was a total spectacle. A lot of the sources we looked at kind of derisively call it the yield-chasing playground.
Because the main draw was these insane APYs. Absolutely. The headline feature was always the promise of astronomical annual percentage yields, often like 100%, sometimes way more, just to get users to provide liquidity to deposit their crypto.
But those yields,
Mm.
they weren't really sustainable, were they? They were mostly paid out in the protocol's own token, which they were just minting constantly.
That's the core problem. Correct. It created this really toxic inflationary cycle. The super high yields attracted money, sure.
Yeah.
But as soon as the price of that native token started to drop because everyone was immediately selling the rewards they were getting.
To lock in the profit.
Right. As soon as that selling pressure hit, the APY would just plummet. And then all that capital, that mercenary capital, would instantly flee to find the next protocol offering crazy yields. It was liquidity mining just for the sake of having liquidity, not really tied to sustainable revenue generation.
Okay, so that was then. What about now? The sources say this is the DeFi value era because projects have completely shifted focus.
Yeah, the focus now is totally different. We're seeing these major shifts towards what they call sustainable tokenomics, things that really emphasize capturing value, not just giving it away.
Like what specifically?
Well, things that actually mimic traditional corporate finance, surprisingly.
Hmm?
Treasury-funded buybacks are a big one. Explicit fee redistribution actually giving some of the earned revenue back to token holders. And just a hard pivot towards value accrual based purely on, utility and profitability. Does the protocol actually make money?
And this shift, this is what gives it institutional credibility. Is that the term the sources use?
That's the term, yeah.
And it's crucial. Think about it. Traditional financial institutions, big asset managers, even large DAOs, decentralized autonomous organizations, they aren't typically interested in pouring millions into purely speculative assets where the value is just based on like token inflation hype. They need something more solid.
Exactly. They require clear, predictable revenue models, sensible treasury management. When a protocol takes its hard-earned fees and uses them to buy back its own token, maybe even burn it, that signals long-term financial prudence. It looks more like a real business.
Okay, this next point you flagged feels really critical. If this re-rating is happening, who are these investors focusing on fundamentals? And how are they even valuing these things? The sources mentioned investors are actively re-rating tokens like UNI, Aave, CRV, viewing them more like profitable digital businesses.
Yeah, it's fascinating. They're essentially trying to apply traditional financial metrics, or at least analogs of them. Think like price-to-earnings ratios, but for DeFi protocols.
So comparing market cap to actual revenue.
Basically, yes. They look at the verifiable, transparent on-chain revenue. And remember that $600 million in fees is super easy for anyone to audit on the blockchain. And they compare that against the token's total market cap.
And if the revenue is high relative to the market cap.
Then the token might be seen as fundamentally undervalued, especially, and this is key, if the protocol has committed to capturing that value through things like buybacks, these deflationary mechanics we mentioned.
So the accumulation we're seeing isn't just random retail buying.
The argument is that a significant part of it is driven by these fundamentals-based investors. And this suggests we might be at the beginning of a multi-quarter DeFi rally, one driven specifically by this real yield narrative. Not just hope, but actual earnings.
Okay, and to really get the roots of this whole real yield movement, we have to talk about the pioneer, right? MakerDAO. They kind of showed everyone else how it could be done.
Yeah.
Connecting DeFi to real-world revenue streams.
Absolutely. MakerDAO, with its MKR token, they really set the precedent here. Their mechanism was, frankly, structurally brilliant. Instead of only relying on the fees from people borrowing their stablecoin, DAI, they diversified.
How so?
They started using the high-quality collateral that backs DAI specifically. They integrated real-world assets, RWAs, things like actual U.S. Treasury bills.
Which, in the traditional finance world, are seen as basically risk-free income generators.
Precisely. So the yield generated from those two bills, which is stable, predictable, off-chain income, that yield was fed back into the Maker protocol's treasury.
Ah, so a sustainable, non-inflationary revenue stream.
Yeah.
Not just dependent on crypto market activity.
Exactly. It was verifiable. It was stable. It proved that a DeFi protocol could actually operate like a profitable, diversified financial entity. And that model, that success, directly inspired the tokenomics and fee accrual structures we're now seeing pop up across other major protocols like Aave, Synthetics, and even GMX.
Right. Maybe we should briefly touch on those two. You mentioned Synthetics and GMX. They're big revenue generators too, right? But maybe less understood than just simple swaps or lending.
Yeah, that's essential context because they contribute a lot to that $600 million. Synthetics focuses on synthetic assets derivatives that track the price of other assets. This involves pretty complex stuff. High-frequency trading, collateralization. They generate fees through liquidations and exchange fees on these synthetic derivatives. Okay, complex but profitable.
Very. And GMX. They focus on decentralized perpetual futures trading. Now, because perps involve huge amounts of leverage, and constant trading volume traders are always paying funding rates, execution fees, these kinds of platforms inherently generate extremely high, very verifiable, and pretty consistent revenue.
Like a digital casino that always gets its cut?
That's a pretty good analogy, yeah. They're fundamentally profitable by design, and that really drives up that overall $600 million fee total. So, MakerDAO laid the blueprint for sustainable profit. Derivatives platforms prove the sheer revenue potential. This whole maturity story leads us right to the biggest fish in the pond volume-wise. We got to talk Uniswap next, Section 2, the absolute dominant force in decentralized exchange.
Yeah, Uniswap's dominance metrics are just unparalleled. Still the world's largest DX, it consistently holds around 60% of all DX trading volume.
60%, with thousands of competitors.
Exactly. 60% isn't just dominance, it's practically a quasi-monopoly. And it's driven by having the best liquidity and, crucially, user trust that's built up over time.
And that dominance, that's the engine, pumping out a huge chunk of that $600 million fee rebound we keep talking about.
Absolutely. Uniswap generated hundreds of millions just in swap fees alone. It significantly outpaced even established competitors like Curve or, the historical giant SushiSwap. The sheer volume flowing through it makes it a revenue powerhouse.
Despite generating all this money, there's always been this big debate, right? About actually giving some of that back to UNI token holders.
Yes, that's the critical ongoing community discussion. Fee redistribution. Because historically, even with hundreds of millions in revenue flowing through the protocol, the UNI token itself has only ever really offered governance rights. A right to vote on proposals, not a direct claim on the cash flow.
Which feels like a massive missed opportunity for value accrual, doesn't it? The sources really highlight this fierce debate happening now in 2024 around the Uniswap fee switch proposal.
Yeah, it's a hot topic. If that governance proposal passes, it would finally activate a mechanism, the fee switch, that diverts a portion of those swap fees directly to people who hold and stake their UNI tokens.
And the implications of that would be huge.
Enormous. It would instantly transform the UNI token. It would go from being just a speculative governance asset to being a token with real yield, a direct share in a profitable digital business.
So why the debate? What's the holdup?
Well, it's complex. There are concerns about potential regulatory scrutiny. If it looks too much like distributing dividends like a traditional security, that's weighed against the clear economic argument for rewarding long-term holders and aligning incentives. It's a tough balancing act.
Okay, so that's the potential future. But what's actually fueling the rising volume right now that's generating these massive fees? The sources point squarely at layer 2s, right? L2 scaling solutions.
Absolutely. The explosion in L2 adoption is the key catalyst here. We're talking about solutions like Arbitrum, Optimism, and increasingly Base.
And these L2s basically just make transactions cheaper and faster.
That's the core function, yes. They are the infrastructure upgrade that arguably made this $600 million quarter even possible. Think back to the Ethereum mainnet gas fees, sometimes $30, $50, even more, just for a simple swap.
Yeah, unusable for small trades.
Exactly. That friction just limited throughput. It discouraged small, everyday transactions. L2s drop those fees down to pennies, sometimes fractions of a penny. That removes the barrier to entry, and it just drives exponential growth in user activity and the sheer number of transactions.
Which is the direct input for Uniswap's revenue engine.
Precisely. It's a beautifully simple feedback loop, really. Cheaper rails mean more traffic. More traffic means more tolls, more fees, higher protocol revenue, and we have a perfect example of this bridging the gap to the mainstream. Coinbase's Layer 2, Base Network.
Yeah, Base becoming one of Uniswap's most active chains. That's a really profound validation point. Think about what's happening there.
A huge, regulated, centralized exchange.
Exactly. Coinbase is actively directing and funneling its users' retail, maybe even some institutional flow, onto a Layer 2 network, which then directly fuels the usage and thus the fee generation of a purely decentralized exchange like Uniswap.
Wow. So CEX is feeding DXs via L2s. It completely validates the thesis that centralized and decentralized finance aren't necessarily enemies, they can coexist, and L2s are acting as that critical bridge between them.
That integration really does solidify the whole L2 scaling thesis, doesn't it?
Hmm.
If you were analyzing Uniswap's health now, you wouldn't just look at its mainnet activity.
No way. You'd have to track the fee distribution across all the chains that's on Ethereum mainnet, sure, but critically Arbitrum, Optimism, and especially that surge of activity on Base. That's where you see the L2 growth thesis playing out in hard, transparent revenue numbers.
The surge on Base really shows that mainstream interest isn't just talk anymore. It's translating into actual usage on the most efficient infrastructure available.
Yeah, it's arguably the ultimate validation for the entire Web3 scaling strategy so far.
Okay, so moving from the king of exchanges to the king of lending. Let's transition smoothly into section 3. Let's look at Aave, often called the bank of DeFi, right?
That's a good way to put it. Yeah, Aave is the leading protocol in the DeFi lending space. It benefits directly pretty much every time on-chain borrowing demand goes up.
And that demand could come from anywhere. Traders wanting leverage, maybe DAOs managing treasuries.
Exactly, or even just users who need some capital and want to borrow against their existing crypto collateral. Aave serves all those needs.
And its fee generation is pretty diverse too, right?
Right.
Contributing tens of millions to that $600 million total.
Yep. It earns interest fees, obviously, from the spread between what it pays lenders and what it charges borrowers. But importantly, especially in volatile markets, it also earns significant revenue from liquidation fees.
When someone's collateral value drops too low and the loan gets closed out.
Precisely. When the value drops below the required maintenance threshold, the position is liquidated, and the protocol takes a fee.
So volatility can actually be good for Aave's revenue.
In a way, yes. The sources suggest that Q3, while showing this fee resurgence overall, also had enough market chop to trigger a decent number of liquidations. And those liquidation fees are essentially high-margin revenue for the protocol. It underscores how Aave can stay profitable even when markets are turbulent.
Which has got to be a huge plus for those more risk-averse institutional investors looking at the space.
Definitely. It signals a robustness, a resilience in the business model.
But what really locks Aave into this DeFi value era, according to the sources, is its recent, pretty significant pivot towards token buybacks. This wasn't just a minor thing, right? It was a major governance decision.
Yeah, a huge decision to use the protocol's actual revenue, those tens of millions it earned, to actively go out and purchase the AAVE token on the open market, effectively reducing the total supply over time.
And the sources pointed to a specific proposal.
That's right. They highlighted a Hive's Treasury Proposal 12. And the key thing about Proposal 12 is that it approved not just a one-off buyback, but a continuous buyback loop.
Continuous, so it's ongoing.
Yeah, it ensures that a defined, ongoing portion of the protocol's income is regularly used to purchase AAV from the market. It's like a commitment baked into the governance and potentially the code for long-term value accrual through supply reduction.
Okay, this is where we really need to draw that parallel to traditional corporate finance. It sounds a lot like a stock buyback program.
It's very analogous, yes. When a public company earns profits, it can reinvest, pay debt, or return value to shareholders. Two main ways for the latter are dividends or stock buybacks. Aave is clearly adopting these shareholder-style mechanics, as the sources put it.
So explain that. How does a stock buyback work, and how is Aave mimicking it?
Okay, so in TradFi, when a company uses its earnings to repurchase its own shares from the open market, it immediately reduces the total number of outstanding shares. All else being equal, this should increase the earnings per share for all the remaining shares. It makes each remaining share represent a slightly larger piece of the company's profit. Aave's buyback program aims for a similar effect on the AAVE token supply. By using revenue to buy back tokens, they reduce the circulating supply. So if you're holding AAVE, you now hold a piece of this profitable digital business that is actively shrinking its supply, which should, theoretically, make your remaining stake more valuable over time.
But it's a buyback, not a dividend, right? A dividend is cash paid directly to the holder. Why choose buybacks? Does the source material get into whether buybacks are actually the best way to distribute value, or maybe just like a more convenient or tax-efficient way for a DAO?
That's a great nuance. The sources do address the efficacy, mainly emphasizing the strategic advantage for a DAO structure. A buyback, especially if followed by burning the tokens or just holding them in the treasury, neatly sidesteps the potentially very complicated regulatory landscape that might come with distributing something that looks like a cash dividend.
Regulatory arbitrage almost.
You could see it that way. It's just cleaner, more autonomous for a decentralized entity operating globally. And it immediately impacts the supply side of the token's economic equation. For many protocols, achieving value accrual through creating scarcity is seen as strategically superior, or at least simpler, than navigating the legal maze of direct cash-like distributions.
Value accrual through scarcity, not direct payment.
Got it.
That clarity is important. Okay, and finally, when we're analyzing Aave's health, we need to look at its total value locked, its TVL, alongside this fee revenue, right?
Absolutely. TVL is kind of the metric for trust and capital confidence. The more value locked in Aave's smart contracts, the more the market trusts its security and utility.
What do the sources show there? Is TVL strongly correlated with the fees?
What's interesting is that the sources show Aave has maintained really robust profitability and high fee generation, even during periods where TVL might have fluctuated a bit due to market conditions or volatility.
So the income isn't solely dependent on TVL constantly going up.
Exactly. It shows resilience. That combination, deep trust in the code reflected in high TVL, combined with consistent business income, even if TVL dips temporarily, that's precisely the kind of profile institutional players look for when they're trying to de-risk their DeFi investments. It really confirms the sustainability of the underlying business model.
Okay, wow. We've really covered a lot of ground there. We've done a pretty comprehensive breakdown. The $600 million fee event, the rise of this real yield narrative, Uniswap's dominance being supercharged by L2s, and Aave pivoting to these corporate-style buybacks. Let's try to connect all the dots now in Section 4. What are the broader implications here for the whole Web3 ecosystem?
Yeah, this resurgence really gives us a chance to synthesize things. We can almost define a new fundamentals checklist that successful mature protocols seem to emphasize now, marking that shift away from those old inflationary models.
Okay, let's list them out. Checklist item 1.
Fee generation over inflationary rewards. Revenue has to be earned through actual utility, actual usage, not just printed out of thin air through governance votes.
Makes sense. Checklist item 2.
Deflationary tokenomics. Specifically, things like token buybacks and burns, deliberately designed to strengthen the value for each holder by reducing the overall supply pressure. Often managed through those continuous loops we talked about, like the IG's Proposal 12.
Okay, and checklist item 3.
Robust, genuinely on-chain governance mechanisms, but with a focus now explicitly on sustainable treasury management, ensuring the protocol stays solvent, can fund its own growth long-term, and doesn't constantly need to rely on outside VC funding rounds.
And this evolution, ticking these boxes, it's not just a nice-to-have trend, is it? It's basically the entry requirement for getting serious institutional money involved.
Absolutely. It's the prerequisite for achieving that large-scale institutional credibility we mentioned earlier. Institutional investors, hedge funds, even conservative DAOs making allocations, they are now laser-focused on finding DeFi protocols that actually generate revenue and meet this kind of checklist.
The due diligence process demands proof of being a solvent digital business, not just cool tech.
Exactly.
Yeah.
Not just an exciting experiment anymore. And critically, this entire $600 million resurgence, it validates the Layer 2 scaling thesis in the most undeniable way possible. Through cold, hard cash revenue. Totally. If L2s didn't exist, if swapping still cost $50 on mainnet, Uniswap could never have achieved the sheer transaction throughput needed to generate hundreds of millions in fees. It just wouldn't be economical.
So L2s are like the highways that enabled this DeFi commerce.
That's a great analogy. The old Ethereum mainnet was like a beautiful, secure, but incredibly expensive cobblestone road. Maybe fine for large settlements, but not daily commerce. L2s are the efficient, multi-lane highways needed to support actual high-volume commercial activity. That's why this $600 million figure feels possible now, and maybe even sustainable. L2s are the essential infrastructure.
Okay, and zooming out to the macro picture.
Yeah.
There's always this narrative about coexistence, with
Yeah.
Bitcoin ETS approved, big centralized exchanges offering yield products, TradFi players dipping their toes in. Some people wondered if DeFi still had a unique value proposition.
Right. Would it just get swallowed up or
Yeah.
made redundant?
But this resurgence seems to prove there's definitely still viable, sustained demand for transparent, on-chain alternatives, even with all that happening. I think it really highlights DeFi's fundamental competitive advantage, transparency. While a centralized platform, say like Coinbase or Binance, can offer similar services lending, swapping, they just inherently lack the verifiable, instantly auditable nature of the on-chain revenue streams we've been discussing. Anyone can go check the blockchain records for Uniswap for Aave's fees.
Exactly. That level of transparency provides the degree of trust, especially for larger players or DAOs, that centralized, opaque entities simply cannot match. It's a different value proposition. Which brings us, I think, to the real key takeaway from all the source material we synthesized. The future of crypto isn't just speculation, it's not just meme coins anymore. It's increasingly about these profitable, decentralized protocols that can actually sustain themselves financially without constantly relying on VC cash injections or needing perpetual hype cycles. That's the definition of real anti-fragile resilience, isn't it? Being able to stand on your own 2 feet financially.
And that resilience point is perfectly shown by that supporting story about Curve's recovery. They had that massive exploit in 2023, right? A huge crisis of confidence.
Yeah, a significant reentrancy exploit. It could have been fatal, a major vulnerability, a run on their liquidity. It was bad.
But they didn't just fold or fade away. How did they rebuild?
Well, they didn't rebuild by launching some flashy new high APY incentive program. They rebuilt trust by doubling down on their core business-efficient stablecoin swapping and lending, and by prioritizing generating organic revenue again, proving the model still worked, and just generally building back trust step by step.
So focusing on the fundamentals again.
Exactly. They did need to recapitalize, sure, which involved community efforts and some outside help. But the core of their recovery narrative was demonstrating that the underlying business model facilitating stable asset exchange efficiently was fundamentally sound and could generate enough real revenue to restore confidence over time. Their comeback story really reinforces this whole fundamentals over hype trend we've been tracking.
It really shows the infrastructure itself is maturing, doesn't it? To the point where protocols can actually survive major black swan events, which maybe wasn't true back in 2021.
Yeah, I think that's fair. And if you look across the board now at the top revenue generators, UNI, AAVE, Maker, maybe Lato with staking fees, GMX with perp fees, they all share that common thread, don't they?
They're essential financial infrastructure pieces, not just speculative tokens.
Right. They perform a core financial function, and they generate verifiable, transparent income from doing it. The whole ecosystem seems to have shifted its focus. It's less about attracting temporary capital through high inflation and more about retaining capital through demonstrable value capture and, frankly, just sound financial engineering.
It feels like the difference between, I don't know, an exciting science experiment and an actual functioning economy.
Well put, yeah.
Okay, that was a truly comprehensive deep dive. We really got into the weeds of that $600 million fee resurgence. We covered the big shift to value-based tokenomics, the L2 explosion driving Uniswap's massive volume, and Alziv's interesting move towards those corporate-style buybacks.
Yeah, we covered a lot. But before we wrap up, we wanted to leave you, the listener, with one final, maybe provocative thought. It's a key question that came up implicitly in the source material.
Okay, what is it?
We've seen all these impressive metrics, right? The $600 million, the governance shifts, the talk of maturity. But is this truly DeFi 2.0 finally arriving like a fundamentally new iteration of decentralized finance?
Right.
Or is it maybe just rebranding old solid financial concepts, like dividends and stock buybacks, but dressing them up with new crypto buzzwords like real yield and token buybacks?
So is it fundamental innovation or just clever marketing of existing financial mechanics under this new decentralized banner?
Exactly. It's a question about the nature of innovation versus maybe just strategic imitation using blockchain rails. Something to mull over.
That is definitely the homework for everyone listening. A deep question. And hey, remember, the kind of high-quality content and in-depth analysis we just went through, it really relies on community support to, well, reach more people who might find it valuable.
Yeah, definitely.
So if you found this deep dive useful, we genuinely encourage you to engage with the content. Drop a comment below. Tell us what you think. Is this the real return of sustainable DeFi? Or maybe just the early innings of an even bigger wave coming?
Yeah, we'd love to hear your take.
Those simple acts, subscribing, commenting, liking, interacting, they really do help boost visibility in the algorithms. And honestly, that's what ensures we can keep creating these detailed, high-signal crypto insights for you each week.
Your engagement really does fuel this kind of analysis. So seriously, thank you for diving deep with us today.
Until next time.